He turned down a raise, not because he was broke, not because he was being modest. He turned it down because accepting it would have cost him $2 million. That sentence probably broke something in your brain, and it should. Because everything you have been told about building wealth, work harder, earn more, climb the ladder, chase the bigger paycheck, is not just incomplete. In some cases, it is the exact trap keeping ordinary people from ever escaping the cycle they are desperately trying to break. The people quietly building generational wealth right now are not doing it by maximizing their salaries. They are doing something far more calculated, far more counterintuitive. And the moment it clicks for you, you will never look at your paycheck the same way again. So stay with me, because what I am about to break down changes everything. Let's start with a name you might recognize. It is not Elon Musk or Jeff Bezos. It is your neighbor, the one who drives a modest car, works a regular job, and somehow just bought their third rental property. They are not a genius. They are not lucky. They are playing a completely different game than you are, and they figured out one rule that most people never learn. That rule is this: your salary is taxed first. Your wealth is built with what remains. But when you control how you pay yourself and how much, you can legally redirect enormous amounts of money before the government ever touches it. Here is how this actually works in practice. A self-employed professional or small business owner who earns, say, $150,000 in revenue does not have to take all of that as personal income. They can pay themselves a reasonable salary, sometimes as low as $50,000 or $60,000, and then distribute the remaining profits in a way that attracts far lower tax rates, or in some cases, almost no tax at all. The difference in tax treatment between earned income and pass-through income, long-term capital gains, or qualified dividends can be staggering. We are talking about a gap of 20, 25, even 30%, depending on your structure and your state. On $100,000 of redirected income, that is $30,000 staying in your pocket instead of disappearing into the tax system. Now multiply that by 10 years. That is $300,000 in saved taxes alone, money that has been silently compounding on the side while everyone else is handing over a massive slice of every dollar they earn. And that is before we even talk about the retirement account strategy. If you are enjoying this breakdown and it is already shifting how you think about money, take 2 seconds right now to hit that like button and subscribe. This channel is built for people who want the real mechanics of wealth, not the motivational fluff. New videos drop every week, and you do not want to miss what is coming next. Now back to the retirement account angle, because this is where it gets genuinely powerful. Business owners who keep their salary in a controlled range can max out certain retirement vehicles that employees simply cannot access. A solo 401k, for example, allows contributions of up to $66,000 per year as of recent limits. A simplified employee pension IRA can shelter up to 25% of net self-employment income. These accounts grow tax-deferred, meaning the money compounds without being interrupted by annual tax bills. Meanwhile, the person celebrating their promotion to a six-figure salary is now in a higher bracket, losing more of every dollar, potentially phasing out of certain deductions, and finding that their actual take-home increase feels shockingly small compared to the raise they received. This is the paradox nobody talks about at work. More income does not automatically mean more wealth. It often means more exposure, more taxes, more lifestyle inflation, more complexity, without a proportional gain in real financial freedom. The millionaires who understand this are not hiding from success. They are engineering it differently. They are building entities, LLCs, S corporations, holding companies that serve as wealth containers. Revenue flows in, expenses and strategic costs flow through, and only a controlled portion surfaces as personal taxable income. The rest goes to work in assets, real estate, index funds, private lending, business equity, things that grow quietly and are taxed gently or not at all until you choose. Think about what this means long term. 2 people, same revenue. One takes it all as salary and pays peak income tax rates. One structures their compensation intentionally and shelters the excess. After 20 years, the difference in net worth is not marginal. It is the difference between comfortable and genuinely, life-changingly free. There is also a behavioral element to this that rarely gets discussed. When you keep your personal salary modest, even artificially, you preserve a scarcity mindset around personal spending while giving yourself access to capital through your business for investments and growth. You are not depriving yourself. You are simply keeping your personal lifestyle anchored while your asset base expands. It is discipline disguised as a tax strategy. The people who crack this code earliest tend to have one thing in common. They stopped asking, "How do I earn more?" and started asking, "How do I keep more of what I already earn?" That shift in question leads to a completely different set of answers and a completely different financial destination. So, what should you actually do with this information? First, if you are self employed or thinking about starting any kind of business, talk to a CPA who specializes in tax strategy, not just tax filing. There is a massive difference. One looks backwards, the other looks forward and helps you architect your income. Second, learn the difference between earned income, passive income, and portfolio income. The tax code treats them very differently, and knowing this is the foundation of everything. Third, start thinking in structures, not just in dollars. The vehicle you use to earn and hold money matters as much as the amount you earn. The salary you chase might be the cage you build for yourself. The wealth you architect quietly on the side might be the door out. Hit that subscribe button right now if you want to keep going deeper into exactly how this works. Entity structures, real estate tax advantages, how to legally pay your kids, the backdoor Roth, and everything else the wealthy do that nobody teaches in school. It is all coming, and you are exactly where you need to be to learn it.